You know, we actually had to prove we weren't robots to pull the research for today's deep dive.
Yeah, literally clicking on pictures of traffic lights and crosswalks.
Right, exactly. And the irony is we were doing all that bot checking just to investigate a company that is quietly building one of the largest armies of AI agents on Earth.
It is just the ultimate 2026 moment. I mean, you are sitting there verifying your humanity so you can read an earnings report about autonomous digital workers.
Yeah, and this isn't some scrappy Silicon Valley startup beta testing software out of a garage somewhere.
Oh, definitely not. We are looking at a 75-year-old giant.
Exactly. We are diving into ADP. Specifically, we're looking at their Q3 fiscal 2026 earnings call from April 29, 2026.
And if you're listening to this, when you hear ADP, you probably just picture that little red logo sitting in the corner of your pay stub.
Yeah, they have this really entrenched reputation as a steady, reliable, and frankly, somewhat sleepy human resources tool.
The boring payroll company.
Right. But our mission today is to look completely past that legacy reputation. We are going to unpack how this global giant is fundamentally rewiring the underlying mechanics of work for millions of people.
Which honestly very likely includes you, the listener.
Oh, absolutely. But, rewiring the mechanics of work sounds like a pretty lofty claim.
It does, until you look at the sheer, unadulterated scale they operate at. I mean, we are talking about processing payroll for over 1 million separate clients.
Spread across, what, 140 different countries?
Yeah, exactly. And these Q3 numbers, they paint a picture of a company that is not just coasting on decades of momentum. They are actually using that massive size to accelerate past competitors.
So let's set the table with the actual numbers before we get into the mechanisms of how they're doing it.
Sure.
Give us the headline metrics from Q3, but, don't just dump the spreadsheet on it. So what is the one number that actually tells this story here?
So the single most telling metric is their adjusted EBIT margin, which jumped by 80 basis points to 30.2%.
Okay, wait. For anyone who doesn't live in financial statements every day, EBIT is earnings before interest and taxes, right?
Right.
So it's essentially a pure look at their operational profitability.
Precisely. It measures how much profit they make from their core operations alone. So their total revenues hit $5.94 billion.
Which is a 7% increase, right?
Yep, a 7% increase. But the fact that their EBIT margin expanded by 80 basis points means they're doing way more with less.
Ah, I see.
They aren't just growing revenue by spending a proportional amount of money. Their underlying machinery is actually becoming significantly more efficient.
Okay, so that operational leverage is what drove their adjusted diluted earnings per share, or EPS, up 10% to $3.37.
Exactly.
I mean, almost $6 billion in top-line revenue for a single quarter, and the machinery gets more efficient as it scales. The big question is how.
Right. Why is a legacy HR platform doing this well?
Yeah, why are they not only beating market expectations, but actually going out of their way to raise their full-year guidance for 2026? What's the catalyst?
Well, the catalyst is a massive structural shift in how they view technology. They are openly pointing to artificial intelligence as the driver of this efficiency,
Okay.
and they aren't treating it as a novel feature. Maria Black, their CEO, framed it perfectly in the earnings release.
What did she say?
She stated, AI is adding new layers of complexity to our clients' work, and we are well into building the capabilities to meet that moment.
Okay, let me stop you right there and push back on that quote a little bit.
Fair enough.
Because, I mean, in 2026, every CEO on the planet is basically legally obligated to say the word AI at least 5 times on an earnings call just to keep investors happy.
It's the buzzword of the decade.
Exactly. It is the easiest way to generate a quick headline. So is this actual functional technology putting points on the board, or is it just corporate buzzword bingo?
You mean, are we just talking about a glorified chatbot bolted onto a customer service page?
Yeah, exactly, just to deflect complaints.
Well, look, the skepticism is absolutely warranted, but the report details specific deployments that move well beyond that hype phase.
Okay, I'm listening.
They outline 3 distinct functioning areas of AI integration. The first is a suite called ADP Assist. These are AI agents deployed directly into the platform to address workforce challenges.
Okay, walk me through what an AI agent actually does in a payroll context. Give me the actual mechanism.
Okay, think about the man-hours required to resolve a payroll discrepancy for a mid-sized company. Say, an employee claims their overtime was calculated incorrectly.
Right, which happens all the time.
All the time. Historically, a human HR rep has to pull the timesheets, cross-reference state-specific labor laws, check the company's internal multiplier policies, and manually calculate the difference.
That takes hours.
It takes hours. But ADP Assist acts as an intelligent system that can instantly audit 6 months of clock-ins, apply the local regulatory framework, flag the anomaly, and propose the exact mathematical fix.
In like, what, seconds?
Literally in seconds.
So it completely eliminates the administrative triage. It turns a half-day investigation into a push notification.
Exactly. It fundamentally changes the capacity of an HR department. And, that is just their proprietary tool.
There's more.
Yeah, the second area they detail is an agentic AI ecosystem. They have launched a dedicated space within the ADP marketplace specifically for third-party AI agents.
Oh, wow. So they're essentially building an app store, but instead of apps, you download autonomous digital workers.
That is a brilliant way to visualize it, yes.
Yeah.
They are creating a secure hub where outside AI tools can interact with ADP's colossal anonymized datasets.
Okay. And the third initiative?
The third initiative is something they call internally the zone.
Uh-oh. The zone sounds incredibly ominous.
Right.
Like a sci-fi movie where the computers finally lock the doors and take over.
It does sound a bit dystopian, but it's really just their effort to scale generative AI capabilities across their own internal service operations.
Okay, but let's connect this back to the financials. You automate a few million HR tickets, and you launch a marketplace. How does that directly translate to a 10% jump in earnings per share?
It comes down to...
Like, where is the causal link between a digital assistant and the bottom line?
The causal link is competitive advantage driven by scale. Peter Hadley, their chief financial officer, broke down the mechanics of this.
Okay, what did he say?
Because ADP is so massive, they have the financial strength to invest in these capabilities across product development, service delivery, and sales without taking on crippling debt.
Oh, I see the mechanism. If you use AI to instantly flag and resolve issues internally through the zone, you can take on a massive new enterprise client without having to hire a proportional number of human customer service reps.
That is the exact lever driving the EBIT margin expansion we discussed earlier.
They're expanding revenue without inflating headcount.
Exactly. And simultaneously, they're offering an AI product that is deeply integrated into a proprietary data lake of global workforce information.
Which smaller competitors simply do not have.
And cannot buy. That combination unmatched internal efficiency and a product moat that smaller companies can't replicate is what fuels their confidence to raise guidance.
Which is why they're now expecting that 10% to 11% EPS growth for the entire year.
You got it.
Okay, so you tell me that their AI makes them insanely efficient. But when I read through this report and look under the hood at ADP's two main financial engines...
I know where you're going with this.
Right. I see a glaring contradiction. The two sides of the business are telling vastly different stories about profitability.
It is absolutely a tale of two segments.
Right.
The first engine is the Employer Services segment, or ES. When most people think of ADP, the payroll processing, the time management software, they are thinking of ES.
And based on the numbers, the ES segment is an absolute fortress right now.
A rapidly growing fortress. ES revenues are up 7% to over $4 billion, and let's look at the underlying metrics driving that. Their U.S. pays per control is up 1%.
Okay, let's clarify that term real quick, because pays per control sounds like industrial jargon.
Yeah, it does. It simply refers to the number of individual employees on their clients' payrolls.
Okay.
A control is an employer entity. So this metric acts as a real-time proxy for macroeconomic hiring.
It means ADP's clients, on average, are expanding their workforces by 1%.
Exactly. Furthermore, their new business bookings are growing robustly. But the most critical metric for a subscription-style business model is retention.
Right.
And ES client revenue retention reached a new record high for a third quarter.
I mean, high retention makes total sense. The switching costs in human resources are astronomical.
Oh, yeah.
Changing a payroll provider isn't like changing your email client. It's like performing open-heart surgery on your company's administrative operations while the patient is awake and trying to do their job.
That is painfully accurate.
Once a company integrates with ADP, especially with all these sticky new AI tools, the friction to leave is just way too high.
And because of that locked-in scale and the operational productivity we noted, the ES segment margin jumped an incredible 130 basis points to 41.1%.
Okay, so Employer Services is expanding margins and basically printing cash. But this brings us to the friction point. Let's look at the second engine, the PEO Services segment.
Yes.
PEO stands for Professional Employer Organization. Let's contrast that ES boom with what's happening here because the math gets super confusing.
So a PEO operates on a co-employment model. Instead of just selling software, ADP legally becomes the employer of record for a client's employees for tax and administrative purposes.
Right, they handle all the benefits, workers' comp, payroll, compliance.
Exactly. And on the surface, the top-line growth mirrors the other segment. PEO revenues are also up 7%, coming in at nearly $1.9 billion for the quarter.
Managing a lot of people too, right?
About 762,000 worksite employees across the globe.
So top-line revenue is up, worksite employees are growing, but the margins in the PEO segment went in the complete opposite direction.
Yeah, they really did.
While the ES margins jumped up, PEO margins actually dropped by 120 basis points, landing at 13.0%. How does a company implement AI, get vastly more efficient overall, but simultaneously become less profitable in a segment that's growing at 7%?
Well, the earnings report is very explicit about the specific costs dragging this margin down. The biggest culprit is the massive growth in what the industry calls zero-margin benefits pass-throughs.
Okay, we need to unpack that phrase right now, zero-margin pass-throughs.
It's a mouthful.
It sounds like a really complex way of saying we collected $1, but we didn't get to keep any of it.
That is the literal mechanism. Let's break down how a PEO negotiates. Because ADP represents hundreds of thousands of workers, they can negotiate a massive master health insurance plan with carriers at a better rate than a small business could on its own.
Okay, that makes sense.
ADP collects the premium money from their client to pay for that employee health insurance. But ADP doesn't mark that premium up. They pass the money directly through to the insurance carrier at zero margin.
Oh, okay, so it's less like running a software company and more like being a general contractor building a house.
Exactly.
If the global cost of lumber suddenly spikes, you have to bill your client for the more expensive lumber, and then you pass that money directly to the lumber yard.
Right.
So your total revenue looks way higher on paper because the materials cost more. But you didn't make an extra dime of profit on that wood.
Not a cent.
Your overhead is the same, your profit is the same, but because the raw revenue number inflated, your overall profit percentage shrinks.
The general contractor analogy perfectly captures the dynamic. The lumber in this scenario is employee health insurance and benefits.
Of course, healthcare costs.
Right. As healthcare costs rise across the economy, the volume of these zero-margin dollars flowing through ADP's books increases dramatically.
How much are we talking?
In Q3 alone, these pass-through costs hit an astonishing $1.17 billion.
Wait, over $1 billion inflating the revenue line, but contributing absolutely nothing to the profit line. So the denominator of the margin equation is just getting bigger much faster than the numerator.
Yes. And the report also notes higher state unemployment insurance costs and elevated selling expenses are compounding the pressure. But it's crucial to understand this doesn't signify a failing business model.
Right.
If you strip out those zero-margin pass-throughs, PEO revenues are still up a healthy 5%. It simply reflects a fundamental shift in the macroeconomic cost of providing comprehensive employment administration today.
Which brings up a massive structural question. We have the PEO segment facing very real margin compression from rising healthcare and insurance costs.
Right.
But simultaneously, ADP is pouring an absolute fortune into developing the zone, deploying AI agents, and overhauling their technological infrastructure.
Yes.
How is a legacy company financing this aggressive futuristic pivot without tanking their overall profitability or taking on massive debt?
And this leads us to the hidden financial engine. It is arguably the most fascinating, least understood mechanism of ADP's entire business model.
Okay, let's dive into the float. Because the architecture of payroll necessitates a delay.
Exactly.
An employer runs payroll on a Tuesday. The money leaves the company's corporate bank account. But the employees don't actually get paid until Friday morning.
Right.
For 72 hours, that cash doesn't belong to the employer anymore. And it hasn't reached the employee yet. Where does it go?
It sits in a transitional holding pattern, and that holding pattern is managed by ADP. They refer to this internally as the Client Funds Investment Strategy.
Okay.
ADP is currently sitting on an average client funds balance of $48.3 billion.
Say that again.
$48.3 billion.
Just a temporary mountain of cash floating in the ether between Tuesday and Friday, multiplied by 1 million clients worldwide. That is unbelievable.
And that balance isn't static either. It's actually up 9% from last year, driven by wage inflation and client growth. And naturally, ADP does not leave $48 billion sitting uninvested in a checking account.
Okay, this is where the light bulb goes off for me. This mechanism makes ADP look less like a traditional human resources software platform and more like a highly efficient, short-term financial institution operating in disguise.
It really does.
They are holding tens of billions of the global economy's payroll cash while it is in transit, and they are earning yield on it.
They are acting as a massive liquidity sponge. The report explicitly notes that these client funds are invested according to strict safety guidelines, overwhelmingly in conservative AAA and AA-rated portfolios.
So we're talking about short-term commercial paper, overnight lending, incredibly safe vehicles.
Exactly. But when the principal is $48 billion, even microscopic shifts in interest rates yield astronomical returns.
And the macroeconomic environment has completely shifted over the last few years. We are no longer in a zero-interest rate world.
The earnings data reflects that shift perfectly. Their average interest yield on these client funds increased by just 10 basis points in the quarter.
Which is tiny.
Tiny. It brought the total yield up to a very modest 3.3%. But because of that slight rate increase, combined with the 9% growth in the overall balance, the interest they earned on funds held for clients jumped 14%.
Okay, what was the total?
The total came to $404 million.
Stop right there. $404 million in pure interest income in a single 90-day quarter.
Yes. And looking at their updated full-year outlook for fiscal 2026, ADP expects the total contribution from this client fund's investment strategy to land between $1.3 billion and $1.31 billion.
I'm floored. They are quietly generating over $1 billion a year simply by patiently holding onto the world's money for a few days at a time.
Pretty much.
I mean, a traditional retail bank has to build branches, run marketing campaigns, pay out yields to convince customers to deposit money. ADP gets employers to hand them $48 billion for free, just as a byproduct of running their software.
It is the ultimate manifestation of structural leverage. The strategic value of that $1 billion cannot be overstated. It acts as an incredibly thick, insulated operational buffer.
Because that specific income stream has absolutely nothing to do with whether they sell a new software subscription this month or whether healthcare premiums spike and compress the PEO margins.
None of that matters to the float.
It is a mathematical inevitability based on the payroll volume they already manage.
And that billion-dollar war chest is the exact mechanism that allows ADP to be so ruthlessly aggressive in their technological evolution. It funds the ambitious AI deployments, building the zone, creating the agentic AI marketplace, deploying ADP Assist without compromising their bottom line at all.
Wow.
They can absorb the margin hits in the PEO division, invest relentlessly in next-generation infrastructure, and still raise their overall EPS guidance for the year to that 10% to 11% range.
The underlying financial engine just hums quietly in the background, paying for all the disruption. It is a phenomenal case study in capital allocation. You have a legacy business leveraging its core stability, holding $48 billion in zero-cost client funds, maintaining record-high client retention, managing 750,000 worksite employees, to aggressively bankroll its own future.
Right. They recognize that the entire HR industry is facing an existential transformation driven by data and autonomous AI.
Yeah.
Rather than trying to pivot away from what made them a giant, they are using their massive gravity to ensure they are the ones writing the code for that transformation.
They're essentially turning their own colossal scale into a moat that smaller, more nimble tech startups simply cannot cross.
Exactly. I mean, an AI startup might have a great algorithm, but they do not have a $48 billion float financing their operations.
No, they don't.
Nor do they have 1 million global clients to train their models on.
And this brings the entire deep dive right back to you listening to this right now. The next time you get that direct deposit notification on your phone, or you log in to check your pay stub, just pause and remember that it's not just a simple, localized bank transfer.
Not even close.
Behind that single digital paycheck is a sprawling, invisible global ecosystem. There is a matrix of anonymized data, an expanding network of autonomous AI agents making split-second compliance decisions, and a constantly moving river of $48 billion in transit financing the entire operation.
It's a level of deeply embedded infrastructure that the end user never thinks about, yet the global economy would instantly grind to a halt without it.
Which leaves us with a final, slightly provocative thought to chew on.
Oh, boy.
We started this whole conversation joking about having to pass a bot check just to read about ADP's new army of AI agents. And we've explored how rapidly they're deploying these autonomous ecosystems to parse incredibly complex human resources data and solve workforce challenges. It forces you to wonder, As these agentic AI systems become even more sophisticated and deeply embedded into the very fabric of corporate management, how long will it be before an AI isn't just processing your timesheet or calculating your state tax withholdings?
That's a scary thought.
How long until an autonomous agent is the primary entity, evaluating your quarterly performance, analyzing your daily productivity metrics, and ultimately deciding whether or not you deserve your next raise?
You know, when the software that pays you is also the software that manages you, that line gets very blurry very fast.
Good luck on your next bot check.